It's easy to lose track of the US stimulus programs, there seem to have been so many, so in this video we'll just focus on the most recent one, which is the American Jobs Plan. Now that's going to have an effect not just on the US economy, but on the global economy. And we'll also look at the effect on asset prices, both in equity markets, the bond market, and also the currency markets. So if you do want to support us, remember you can now do that directly via YouTube. You don't have to go to Patreon. Just click on the join button under this video or click on the link beside me to learn more. And if you do that, we can remain independent. So now let's look at the American Jobs Plan in a bit more detail. In a moment, we'll hear Joe Biden describe the plan in his own words, but I think one of the justifications for the way they're going to spend the money was this graph. Now, this is taken from the World Economic Forum report in 2019, where they ranked countries by global competitiveness. That seems like a fairly woolly concept, but it's based on some fairly concrete comparisons. And I think the category which shocked many Americans was here, which is infrastructure. And you can see the US is number 13 based on that category. Now, if we compare the US fiscal stimulus so far compared to other countries, it certainly looks very favourable. This is taken from an article by Michael Kitson in theconversation.com, but when we compare the US and the rest of the world, it certainly seems that their stimulus seems to be much bigger than everyone else's. So first of all, let's hear about the plan, which comes in two parts. This is just the first of that two-part plan.
I'll begin with the heart of the plan. It modernizes transportation infrastructure, our roads, our bridges, our airports. It's about infrastructure. The American Jobs Plan will modernize 20,000 miles of highways, roads, and main streets that are in difficult shape right now. It'll fix the nation's 10 most economically significant bridges in America that require replacement. Remember that bridge that went down? We got 10 most economically significant bridges with more commerce going across it that need to be replaced. We'll also repair 10,000 bridges, desperately needed upgrades to unclog traffic, keep people safe, and connect our cities, towns, and tribes across the country.
As well as building bridges, there's also a clean energy aspect of the plan. And part of that is to build 500,000 charging stations for electric vehicles with tax rebates for people who buy those electric vehicles. They're going to replace 100% of lead water pipes in America, so everybody gets lead-free water from their taps. And there's also a plan for high-speed internet to be rolled out across all of America. Currently, the rural areas tend to be underserviced when it comes to broadband. There's also a problem with energy transmission networks, so those will be improved. And they're also going to improve wages for community-based care. So caregivers, presumably, will get better wages and better benefits. So why are they doing it? Well, I think Biden learnt the lesson from the previous crisis in 2008, when he was sitting alongside Obama during the decision-making processes, and effectively they just pulled the plug on fiscal stimulus once we got this kind of turnaround in 2009. And then it was simply left to the Federal Reserve in order to get the economy moving again, which clearly was insufficient. So if we extrapolate GDP growth in the US based on growth leading up to that crisis, you can see this downward shift in growth relative to where we would have been if the crisis hadn't happened. So the purpose of this fiscal stimulus is to get us back up to a much higher trend growth rate. Now the difference here between these two lines, the potential GDP growth, which is the light blue line, and the actual GDP growth, which is the dark blue line, that difference is called the output gap. But no two people can agree on what it is because nobody can agree on what the true trend potential GDP would actually be. But the size of the output gap really matters because if you stimulate the economy too much, there's always the risk that you get inflation. So here, for example, are estimates of the output gap from UniCredit, which shows that the US fiscal stimulus is much bigger than the output gap. Whereas if we look at the size of the stimulus in the Eurozone, the fiscal stimulus is much smaller than the output gap. But it certainly looks as if the US is going to throw caution to the wind and go for too much fiscal stimulus rather than too little. And the IMF today just published its global outlook for the economy, and they're talking about the stimulus a great deal. In fact, they've upgraded all of their growth forecasts for 2021, and half of that upgrade comes from the US fiscal stimulus because it's going to have a global impact. And what's even more remarkable, if you look above me, you can see that the only country where growth is above the trend before the pandemic is the US. So although the pandemic has been atrocious and we've all hated it, at least this could be described as a silver lining for the US. Whereas if we look at the emerging markets, particularly if we exclude China, the impact has been very negative, and it's unlikely that they'll have the fiscal room, the wealth effectively, in order to stimulate their economies to overcome the growth lag. Latin America and the Caribbean has also been negatively impacted, and there's been a big impact on sub-Saharan Africa as well. Now, a lot of the narrative you hear about inflation on YouTube is that we're going to get hyperinflation or incredibly high inflation because of these fiscal stimuli that we see across the world. But you can see in this graph that if you look at inflation measures recently, they're actually trending downwards rather than upwards. And that's simply because of those large output gaps across much of the world. So why don't they see huge inflation pressures? Well, there are many factors which are pushing down inflation, which have been operating for a long period of time. Globalization is one of them. If you can get goods and services more cheaply across the world, then that tends to push down prices. Automation is another. If robots can manufacture things more cheaply than humans, that tends to push down prices. And here's a fantastic word that you can use during your pub quizzes. It's the word monopsony. Now, a monopsony is very much like a monopoly, but this is for entities that buy goods and services rather than sell goods and services. So if there are some very large employers out there, which there are, they can control wages very effectively. So if there is a monopsony in labour markets, that would tend to keep wage inflation under control. So here's their recipe for what it would take to increase inflation a lot. So firstly, output gaps would have to get large and positive and stay that way for a long period of time. And secondly, central banks would have to be asleep on the job. They'd have to suddenly forget the fact that their job is to control inflation. Now that's very unlikely. Developed market central banks are firstly independent and secondly obsessed with inflation. So it's unlikely that they're going to ignore inflation getting too high. And even though the Federal Reserve has said that it will allow inflation to rise above 2%, which is its target, for some period of time, that'll only be true if it's moderately above its inflation target. If inflation really spikes, you can bet they'll take action by increasing interest rates. So here are those output gaps broken down by country. The red bars are where we're going to be in 2022 to 2023, so that's in the next couple of years. And the blue bars are the average output gap from 2020 to 21, which is when we were affected by the pandemic. So here's the US, which goes from a negative output gap to a positive output gap, as does Canada. But for the rest of the world, you can see the output gap either remains small and close to zero, as is the case in Japan, or it remains large and negative, as it does, for example, in Italy, and then in emerging markets in India, Mexico, and Indonesia. And I love this graph from Claudia Sam, which shows how US potential growth has been downgraded repeatedly. This is the path as extrapolated in 2005. Then after the global financial crisis, it got downgraded. This is where it was in 2010. And then by 2020, it had been massively downgraded. So if potential growth in the US was closer to where it was estimated to be in 2010, then we could have a very sizable output gap. So that's why I wouldn't pay too much attention to the exact size of the output gap. It really is a subjective estimate, and everybody comes up with a different one. So what will the global impacts of this stimulus plan be? These are the estimated impacts on exports to the US between 2021 and 2022 as a direct result of this Biden stimulus plan. So you can see that China actually benefits hugely from the US stimulus plan. Their exports, according to Allianz, will go up by about $60 billion. Mexico is a big exporter to the US as well. They'll benefit, as will Canada. And the UK too will benefit to some extent. And so indirectly, by increasing the demand for goods and services in America, there's going to be an effect on the global economy. And this is now the GDP impact on other countries. Now, clearly, the biggest impact is going to be on US growth, US GDP, but because of those export links, there will be effects for the rest of the world. So primarily that'll be Canada and Mexico, but also countries in South America like Brazil, but also European countries like the UK and the Euro area more broadly. Now, as equity investors, we might be interested in which sectors will benefit from this plan. But what we can't ignore is the sectors which have rallied already, because people have been expecting this stimulus program, which has come in multiple parts. And we've already seen the energy sector rally a lot since the beginning of 2021. It's up almost 30%. And financials, US banks have also benefited because they're a cyclical sector. When the economy is growing, banks tend to do well. So whatever boost we get from this fiscal stimulus announcement will be limited by the fact that we've already had a big rally. And another factor is valuation. This is the latest forward price to earnings ratio for the US equity market broken down by sector. The most expensive sectors are here on the left and the cheapest sectors are here on the right. But it's true that every single sector is expensive to some degree, with consumer discretionary being the most expensive, followed by IT and industrials. One of the sectors that is likely to benefit from the infrastructure plan is materials. So it's good to see that that sector isn't particularly expensive. Whereas industrials, which you can see here beneath me, is fairly expensive compared to other sectors. So my point is you can't ignore valuation when you come to make an investment. Is it already priced in? And if it is already priced in, that could limit the upside on that sector or on that stock. We can also think about what's going to happen to interest rates. Now, in a previous video, I showed what would happen if we go to say 4% on US growth. What would that mean for US 10-year yields? And that suggested that we could have quite a long way to go in terms of yields increasing further. But if we look at where we are now at the beginning of April in 2021, the US has already seen a very rapid increase in interest rates. So this is the 10-year rate. It's currently above 1.7%. And in the UK as well, we've seen a very sharp rise in yields, although it's nothing like on the same scale as the US. But that's not a universal thing. If we look at Japan and if we look at Germany and the Eurozone more widely, we haven't seen those yield increases that we've seen in the US. And that probably means that there's less growth and less inflation being priced into those markets, possibly because their stimulus is considered to be insufficient in size. But interest rates are also important to think about because they affect currency. This is looking at a wide range of currencies versus the US dollar. So if you see a blue bar here, it means the dollar's strengthened versus that currency since the beginning of 2021. And here we're just looking at the first quarter of 2021 as I make this video. Now, what's pretty clear is that we've had a very broad-based dollar strengthening, and that's true whether it's versus emerging markets, which you can see here at the top, but also for some developed markets. So here the dollar has strengthened versus the Japanese yen by about 7% over that quarter. But notice how a lot of the currencies here at the top, which have weakened the most versus the dollar, are emerging market currencies. And that is particularly worrying if you buy emerging market debt. That certainly gives you a high yield, but if those countries and companies in those countries have issued dollar debt, then it becomes harder to service that debt if their currency is weakening versus the dollar. So if this trend continues of dollar strengthening and emerging market currency weakening, then that could lead potentially to an emerging market currency crisis, but also an emerging market debt crisis. And the one everyone's worried about at the moment is the Turkish lira. And what's worrying is the unconventional approach to monetary policy, which the Turkish president has adopted. And when the governor of the central bank in Turkey disagreed with him, he simply replaced him. So that's a clear example of why central bank independence is important. But there are other emerging market currencies which have weakened, the Argentine peso, the Brazilian real, and the Thai baht, for example. Now here at the bottom, you can see that the British pound is one of the few currencies which has strengthened versus the dollar over this quarter. A lot of that strengthening came at the beginning of the year, and that's pretty much turned around now. So sterling is also starting to weaken versus the dollar. I think a lot of that sterling rally was because uncertainty around Brexit had been removed, and sterling rallied as a result. But what I suspect is that now that that uncertainty's gone, that we're going to see the pound succumb to this general trend of weakening versus the dollar. Now, what that means is that if you are an investor in sterling or any of these other currencies and the dollar carries on strengthening, then you'd be better off putting your money into dollar assets. Or if you've got a fund which is currency hedged, you may not want that hedge if your currency is weakening versus the dollar. And conversely, if you're a US investor and you've got foreign investments, clearly a dollar strengthening scenario is bad for you. So in that situation, if you're based in the US, you may want a currency hedged fund. So I hope that's helped you think through some of the consequences of this massive stimulus program, or actually sequence of stimulus programs, and that's helped you build your portfolio. Now, if you do want to learn more about investing, a great way to do that is by signing up for our free weekly market roundup. In that, we'll talk about the latest developments in the global economy, as we did in this video, and also the effect it'll have on markets. And if you want to do that, there should be a link in the description below me and beside me. And, as always, thank you for listening.